Okay, traders, now we're getting set for the run into the US inflation numbers, right? Huge data, big implications for obviously the Federal Reserve interest rates or movement in interest rates coming up in a week's time. So it's really time to start focusing. And what we're seeing across the board is a bit of a correction, right? A bit of a rebalance of positions. If I just show you the charts, first of all, you'll see that if anything, we've seen the dollar go for a massive run, right? So what we're seeing is a bit of traders cashing in, right? Fund managers, etc., locking in because this interest rate or the inflation numbers and the next interest rate decision is still pretty much up in the air. And they're trying to work out whether the dollar continues on this upward bias or sort of drifts lower. So that's where we are. And so why has it sort of moved so far in the lead up to the data? It's because it has rallied a long way and there are no sort of close levels. So we're seeing the currencies, equity indices, commodities all sort of moving a lot freer. And this is really like super normal market conditions, right? You've got to be starting to get excited because what we're seeing now is a potential, if these inflation numbers out of the States are as expected or slightly lower, maybe inflation's topping out. And that's where the other central banks, their actions will start to dominate the US dollar, right? So we're going to see a lot of movement across the board, but let's just focus on the US dollar for the moment, right? So we're seeing obviously euro sort of climb to the top side. Now, this isn't weak dollar on the back of dollar of a weak US fundamentals. It's the anticipation that there may be cooling in the numbers. And if anything, it's seeing traders globally take profit on the dollar in the lead up to the numbers. And that's because the anticipation, obviously, and the implications for the data is quite real. Gold slowly drifting back. Oil's had a nice run to the downside, just coming back to test resistance, and you get another level above there. The good thing is as well, we're seeing a bit of a recharge in the equity markets, right? Another reload. So and that's once again, the exact same principle. They're taking some cash off the table. It really comes down to the number again. If we get strong US numbers, you'd expect the equities to drift lower and vice versa. If we get weaker numbers, well, the weaker numbers are slightly factored in now. We need probably 0.2, 0.3% worse to really get the equity market shooting topside. And that's also that risk on profile has helped the cryptos and commodities. Well, with oil sort of slowly coming back, they are sort of back in the middle of the range there. So a few good, what we've got is really good market conditions with just about all instruments in play. Now, if I just give you a look here, I'll just give you a quick run through the major currencies. As I was saying, like you're seeing this nice dollar sell-off. You can see how much the market was banked in here. Now, euro and dollar Swiss, obviously these two are connected at the hip. Obviously trade like quoted differently. That's why they move opposite directions. But we're seeing some comments from the ECB talking about raising interest rates. Well, that's like dumb and dumber. Of course, they need to at some point, but they're going to have a bit of a conflict here as Europe goes into winter. The whole oil situation with Russia, that could be another problem for them. So I think what we're seeing is a chance to reload on the strong dollar, is my perspective, unless obviously we see some significantly weaker numbers coming out. So this flush out or rebalancing of positions gives us so many opportunities. Okay, sterling, it is above that resistance line. You can see how far it's got, like 300 odd points to go to the next level, but it really, no one wants to take it on just at the moment. If we get weaker US numbers, sterling's probably got to be one of the instruments on your hit list because it does have 300 points to go. Whereas if you look at euro, it's already moved, a couple of hundred points. So you're thinking, well, euro's already moved in anticipation of the ECB doing something, maybe slightly weaker US numbers. If anything, it shows you how short the euro market was, right? So massively short, where sterling wasn't in that basket. Obviously, we've had a situation with the Queen passing. We've had the employment numbers pretty much as expected. On sterling, Aussie also bouncing aggressively. Market super short Aussie, super short Kiwi. These instruments are all ready to bounce. And once again, like sterling, you've got some really big movements here. Like there's a lot of room to the resistance levels. So on weaker US numbers, I'm thinking of looking for pairs that have got a much bigger move to the top side. So if I want to be fair to euro, you've got to have a look at on a bigger time frame, because if you look above this resistance line, right, you're starting to sort of come into levels much higher, right? If I just actually get the toolbar up. Oh, I'll have to draw that one again. So you come over to these levels. So it's right at the top. I'm just trying to work out why I didn't have the initial level here in play. Well, there's another one there. So you can see it here. Actually, if I just get the level right at the top. And just change that so we can see it. Okay. Now, if I widen that out, you can see where that level is. Okay, 102.10. No surprising that it's sort of close to where the euro stopped before. So really, euro needs to get above 102.10, and then you've got a massive run to the top side. This is huge, right? So say, for instance, we had a number, a really weak US number, like 7.2% or something. I mean, they're expecting 8.1%. I'll come into the numbers in a second. But if we got a massive correction, then these currencies are all going to pop. I don't think we're going to get it, but I'm just trying to put the hypothetical out there. So you can see across the board here, it's very easy to identify which pairs have got some movements banked in, which ones haven't. The fact is, it's in the middle of the range here, and for quite a few things, and above resistance levels for some. So it's positioned to move either way on strong or weak numbers. Okay, and this is the kicker, right? And what I mean by that is this is the one that will change the current direction of the dollar, right? And I'll explain that in just a second. But if you look at the equity markets, once again, these have been reloaded. The DAX back in the middle of the range, the stocks, FTSE. I mean, you even get the NASDAQ, and you'd be redrawing these trend lines to the recent lows. S&P, the volatility index, pretty normal sort of levels. And the Nikkei there sort of also sort of pushing topside. So what we're seeing is a recharge in the equity markets. Also, if you're on the cryptos, same principle, right? They are pretty much following the risk on, risk off profile of the equity markets, equity indices. So keep an eye on those. Now, let's just come back to the actual numbers themselves. Let me just change the screen there. Right. So what am I talking about here? Well, it's all about the consensus. Well, that's just an interesting number that's just popped up. Food price inflation New Zealand has just jumped 8.3%. That should give the RBNZ something to think about. Now, let's just get into the US numbers. Now, there's a bunch of different numbers here, right? But what the Fed's looking at is the year-on-year number, okay? The consensus, 8.1%. So, and the previous number was 8.5. So they're expecting a decent correction, okay? The trading economics forecast is the same at 8.1%. So that's really the number you need to be looking at, okay? So whether it's higher or lower from that. Now, with the inflation numbers, like a 0.2% move variation is pretty significant, right? So anything above that, like 0.3, obviously it's a buying situation. If it's so say it's above 8.3, let me just clear that thing there. Above 8.3, you'd expect the dollar to really kick into gear, because it means the Fed's going to have to kick into action again. If it's down around 7.8%, well, that could signal, this is a twofold effect, right? It could signal the fact that inflation is actually topping out, because that's a big correction from 8.5%. So you'd expect the dollar to fall, and you're focusing on those pairs that have free rein to move higher, right? Or even those ones with close resistance levels, actually, which may bring euro into play through 102.10. We see a really significant move to the top side. Now, why is this number so important, right? And I'll tell you, it's because the Fed has been sort of talking about inflation. But if you come up here, right, let's have a look at next week's numbers, right? We have got the Fed meeting, right? The Fed interest rate decision. And this is why today's inflation number is so important. What's the consensus here? Well, it's not sure, because it really comes down to this number, what they're going to do. So the inflation number today is the interest rate decision. If it's above 8.3%, they're going to have to go. Now, trading forecast, these guys aren't done by any stretch. Their forecast already ahead of time is 3.25%. So they're factoring in another 0.75%. Now, for me, I'm sure they'll correct it if the inflation numbers change. So if we get an 8.3, then they're probably correct. 8.3 print on the inflation numbers. If we get a 7.9, I'd say that's going to be, they'll still probably raise rates, but probably by 8.5%, right? So the number itself has implications for next week's, obviously, interest rate decision. And that's why we're sort of getting so pumped about this, because this is really the interest rate decision in one hit. So it's a pretty good one to be following. Now, some of the key details you need to understand. So that's the consensus number. At the time of the release, for those traders who aren't aware or haven't been trading long enough, at the time of the release, you will see liquidity disappear, right? So what I mean by that is you see these nice tight spreads, they will widen out dramatically. And that's the problem with trading extremely high impacting data. It actually isn't as easy as you think, because liquidity disappears and then it comes back again. So trading after the number, like 10 seconds after, is probably better than running with pending orders in there, although you're going to potentially lose the first 30 or 40 points. But for those first 30 or 40 points, you lose control of where you get in. And if the number comes out as expected, you see a spike topside, spike downside, you're out of the cash and you've had a losing trade and the damn thing hasn't moved. So it's a bit of a catch-22. Now, what you need to be able to do is, leading into the number, right, is have a look at the markets, see if there's any uniformity. Okay, we are seeing the equity markets bounce, right? They are closed. The US equity futures are in play. They are rallying, right? We are seeing a very defined risk-on profile. Okay, so at the moment, the Euro, Sterling, Aussie, Kiwi rallying, right? Super directional with the equity markets. Okay, commodities are bouncing across the board as well. Now, if you're wondering why the Aussie's so high, why it's bounced super aggressive, well, it's attached to the commodities. It's a commodity currency, right? So that's why we're seeing the Aussie bounce up so aggressively. So that's obviously an extra thing to consider. So if we see weaker US CPI numbers, you're looking for pairs that could really run hard. Well, the Aussie's already kicked into gear, and that's because the commodities are running hard. So that's one pair to keep an eye on. But the rest, everything, as we get closer to these numbers in just over 12 hours, 13 hours, you're going to see the market sort of really slow down and anticipate. And then as soon as you see the release, they're going to explode. Okay? Just be careful. If you are trying to trade the numbers live, decrease your trade size. Give your stop loss a bit more room, because what you're trying to do is avoid the initial liquidity withdrawal, right? What that means is the spread can widen out momentarily to 40 or 50 points. And that's just because all the liquidity is gone. So if you get in and you've got a 30-point stop, you're already out, even though instantly it may come back to that same level. So it's very careful. If you're trying to dance with the devil, just remember, okay, you can get had over. So that's pretty much it. So what are the implications? Obviously, equity markets are the key one. And that's going to be for global equity markets. You can see the Asian equities rallying, European equities. So whatever happens on the US equity markets will be replicated on the global equity markets. A strong US number, we are going to see the dollar rally, right? And the other pairs fall, and equity markets will fall as well. Like, it's a risk-off profile, right? If we see weaker US numbers, equities will rally. It's a risk-on profile. Equities will rally across the board. Euro, Sterling, Aussie, Kiwi will rally, and the dollar will fall. It's pretty clear cut. Now, leading into this, and I've just sort of been cautious telling you about the liquidity issue at the time of the release. But one thing you've got to take out of this is the confidence in the market, right? These are perfect market conditions. Rallying, risk on. It's like clear as day. You know what to do, right? Taking out the 10 seconds or 5 seconds before the release to the 5 or 10 seconds after. If we didn't have that liquidity withdrawal, everyone would be trading. But that's why it does get volatile at the time of release, because everyone wants to see the answer, and then they all pile in. So just be aware of retracements and those sorts of things. This is a super important number. It is, as I would say, for those people that have taken the course, okay, we're looking at the trade plan. This is the kicker, right? This is the one that gives us the answer to what the central bank is going to do next week. That's why it has implications. And once again, as I was explaining before, right, across all asset classes, we have got so many opportunities, right, with a lot of the various instruments. So whether it's currencies, equities, cryptos, commodities, they're all in play, right? So find the ones that you understand the best, that you have the most affiliation with. Find the ones with the best technical setups, okay? And then work on how you're going to exit or execute those trades, I should say. So, like as you can see, I'm pretty pumped, right? And it's because there's so many things to do. What you've got to do is analyze the market hours beforehand. Then when you turn all your screens off, then come back 10 or 15 minutes beforehand, fine tune, just double check the instruments that you're looking at and the ones that you think could be really beneficial for you, right? Do all your trend lines again. And like sterling here, right? You want to go through. So this thing started to form a bit of a base down here. So you want to be drawing your trend lines so you know exactly, say the US dollar numbers come out strong, where exactly to get in here, right? So you want to be doing that across all your pairs. And that's going to give you the answers on a strong US number and what happens on a weak US number, right? Trying to cover all bases with like trying to cover the top side and downside is problematic. As I said, if you're going in with pending orders, it's a bit of an issue. What you might find is certain pairs are positioned better for one side or the other. Like sterling, there's nothing on the top side here. Same with sort of Aussie for that matter. So weak US numbers to me would run harder across Aussie, sterling and Kiwi, whereas we've seen a massive clean out the top side in euro. So strong numbers here, euro will just fall straight back down again. All right. So that's sort of half the logic. Don't forget the ECB is starting to talk about raising interest rates. Dollar Swiss is one instrument that is really just a dollar trade and it's ready to go anywhere. So potentially dollar Swiss will be just loose as a goose. What we don't have with dollar Swiss that we do have on the downside in some of these pairs is any sort of trend lines so where we know liquidity will be so we can comfortably get in, right? That's where probably euro, you know what? The more I think of it, the more euro with this level here at say 102.10 around there, it's going to provide a liquidity source for us if we do get super weak numbers because it will go up and it gives us levels where once again, sterling, Aussie, Kiwi, it is above current levels. So you know what? The entry is on the number itself, and that is a little bit loose as a goose there as well. So that's where we are, guys. It's as I said, I could talk about this for hours because there's so much connections. You are focusing on these numbers here, and if there's others, this is the situation too. That is the key number. Now, if we get some significant variance in some of these other little bits and pieces, they come out weaker while this number comes out strong. That could sort of cloud things a little bit. But the main focus instantly will be the 8.1. Okay, like Trading Economics is forecasting. These guys are pretty good, 8.1% as well. If it comes out 8.1, that has to be one of your expectations because if it does come out at 8.1, right, I think we see a slight dollar rally because we've seen the dollar drift lower just on a rebalancing of positions on the risk of a weaker number. 8.1 confirms it's still up there. And if it's 8.1, we still may see 0.75% come next week, right? If it's 8.3, I think you can lock in 0.75 and the dollar rallies through the roof. 7.8, 7.9, 7.8 takes off the 0.75. We see the dollar clean out again to the downside. Okay, there's so many things. If only we knew what the number was now, then we can position ourselves. And that's what every trader globally is wishing they could do. All right, so big number. It's got big implications. If you're trading it live, decrease your trade size. Give yourself a decent stop loss to stay in the volatility, right? And that's the way to play it. Trading the number 10, 15 seconds afterwards can be even easier. You may miss the initial move, but that's when you can come back and start looking at your trend lines. All right. All right, guys, that's as much as I can tell you without confusing the hell out of you. Good luck and all the best. Cheerio.